Welcome everybody to our ecological economics class and to our online audience. This is our public lecture as part of the ecological economics course, co-hosted by CUSP, the Centre for the Understanding of Sustainable Prosperity, and the Centre for Environment and Sustainability. And we like to, as part of our ecological, as part of all our modules, we like to include a public speaker giving a public lecture. And this year it's a particular pleasure to welcome Peter, Dr. Peter Michaelis, to give that public lecture, lunchtime lecture. And not the least of the reasons it's a pleasure is that, as I think I relentlessly tell every cohort, Peter was my very first PhD student here at the University of Surrey, and will never ever be anything other than that. He will always be my first. So he does. I think he's very patient with me saying that every year.
It's a good line.
It's a good line, and you guys haven't heard it before. So although you have heard a lot about my former PhD students this week, I do appreciate that. As I recruit them all to the process of teaching you. And as I take it, that's one of the benefits of having PhD students. So with that rather rambling introduction, I should say also that Peter manages the Sustainable Future Funds now at a fund management company called Lion Trust. But as he is about to tell you, and I asked him, I wanted him to tell you this story, it is a kind of a long and winding road, the management of sustainable investment. And Peter has really been there kind of almost from the beginning when sustainable investment was virtually nothing. And he is therefore perfectly placed not only to tell us about sustainable investment, but also to talk a little bit about that journey, which is both a cultural journey in terms of the emergence of sustainable investment and of course a personal journey in terms of the rigours of that almost pillar to post experience that Peter's had managing those sustainable future funds. Peter.
Excellent. Thank you, Tim, and good afternoon, everyone here and online. All the cameras on me. Yeah, as Tim says, it's a real pleasure to be here for what has sort of become my annual return to Surrey University. I think the last one was online though, isn't it? So it's great to be here physically because it's so much better to present face to face than to a screen. It's also nice for me to come back because it reminds me of where I kind of really started my journey, which was actually in a porter cabin, which was sort of sited somewhere now. Now there's a huge building on top of the area that it was, and I basically came to the University of Surrey having done a master's course in energy and the environment at Sussex, having dreams of doing kind of renewable energy, and CES had just been formed and it was offering these ENG-D kind of modules, and I thought, okay, ENG-D, that sounds like the sort of thing that could help me go and work in the renewable energy industry. That was my dream, to work on putting up wind turbines or something. And I arrived, and Ronan Clift, who is here, who's a very persuasive talker, he said, well, we've no more ENG-Ds left. How about a PhD? And I said, oh, okay, PhD. I didn't check the accommodation, where we're going to be working. And I didn't really know what I was letting myself into. But in the end, and with Tim and Roland's careful kind of coaxing and coaching, I ended up doing a PhD based on looking at the life cycle of the steel industry from a sort of thermodynamic perspective and how to optimize it. And using this kind of strange concept of exergy, which is some useful energy, and how to do that. And that was what I did for 3.5 years. And that led to my first job was working in the steel industry, looking at steel construction and how to optimize the environmental impacts of steel. Unfortunately, it wasn't that dynamic a job, it was a bit boring industry. So when there was an opportunity to work in sustainable investment, or as it was then called ethical investment, I thought this is amazing, it's really interesting. And I jumped at the opportunity. And that was in 1999. And I arrived in the investment industry with pretty much zero understanding of investment. But what I did bring, and I think what stood me in good stead, was I had, having done the PhD here and the learning here, I had a good understanding of how business and sustainability could be aligned, and how what kind of good environmental management of business looked like and what didn't. So I gradually learned the investment side of things as we went along. Anyway, that's a bit of a kind of sort of rambling introduction into how I got to be in sustainable investment. And when I joined back in 1999, it was really a little niche. We were called, to our faces, we were the tree huggers in the corner. It was really, why on earth would anyone want to do any of that? And so it was very much the ridicule end of things when I started. And then you sort of scroll forward to today, sort of, possibly. Which one will scroll? No? Sam? You scroll forward today, and the picture is very, very different. So you have many of the largest asset managers in the world talking about their commitment to sustainable investment. Here you go. How will it work? Will it work now? Let's try it.
It's like role reversal, Peter. When I was your supervisor and I gave you instructions.
Yeah.
Now you get to give them to me.
You're carrying it out well.
Thank you. Yeah, it does now work. So very good.
So you can see here, BlackRock, the world's largest asset manager. They say, we believe sustainability should be our new standard for investing. JP Morgan, equally enormous. Sustainability touches every part of our business. As stewards, we take these considerations into account. This is us. Here, Jupiter, another asset manager, and here, UBS, which is, it's making a link saying, will she always be happy? Can sustainable investing protect her future? This is everywhere in our industry. So we've gone from this kind of that is absolutely ridiculous to this is absolutely obvious what you should be doing as an asset manager. And people try and quantify exactly how much is being invested in sustainably and using sort of this lens of environmental, social, and governance. And people talk about half of all assets that are being actively managed are invested sustainably, from it being a minuscule proportion that we were running. And so what I want to talk about over the next 30 minutes is really how that journey, how has it happened, how's it evolved, what does it actually mean, what are the different flavors of sustainable investment, how do we articulate it in the way that we do it. I think I also want to talk a little bit about sort of telling the story, because I think it has implications for a lot of sustainable development and building a sort of better future. And then, as Tim says, to talk about some of the fights and challenges we've had along the way, but also the successes overall that come into it. And then just to finish with a few, concerns around this kind of growth in sustainable investment, and talk about what it has actually achieved and maybe what it hasn't, and then look a little bit towards the future. So I just start by looking at what sustainable investment is, the different approaches. And while I've been doing this 20 years, and so I've definitely been in there from early in the industry, it actually started many years before, and you had certain religious organizations, for instance, or certain people with very strong principles who started around this end in terms of the sort of avoidance. They said, I don't care about any impacts it has on my financial outcome. I am not going to invest in arms companies. I'm not going to invest in tobacco companies. It just doesn't fit with my values. And this is the idea of ethical investing, and it's saying that you can make a decision. You can bring your values to the way in which you invest your assets. And there have been some, the Quakers were, I think, were quite renowned for this, and the Quakers have made they've been very savvy business people along the way, but they have not invested in alcohol or arms to any degree. And so that's one style of sustainable investing, is saying, okay, this is what we won't invest in. And then it sort of evolved, and this really started, I think, in the sort of 1990s or so, to start talking about, well, let's talk about where we will invest, the upside. Let's focus in on companies involved in healthcare, in clean technology, in kind of renewables, and have these kind of themed approaches where you say, okay, we're positively going to offer investment in these areas as part of the landscape of sustainable investment. And then the final bit, which I think is probably what you were hearing earlier from Sean, was around using share ownership to influence and change businesses. So publicly listed businesses are owned by their shareholders. The management work for the shareholders. And so it's for the shareholders to be able to say, actually, we don't think you should be operating in this way. We think it endangers the companies. We think you should pay a lot more attention to human rights within your supply chain, for whatever, or carbon emissions. And this use of sort of the power of shareholding is another aspect of sustainable investing, and this kind of the engagement you can achieve is another part of it. And today, most sustainable investment strategies use all three of these. All three of these come together. And what I always kind of come back to is that what they have in common is that the investors in these strategies care about how their money is made, not just about how much money they make. So it's bringing a different emphasis to it in these three different categories. Excuse me. So if we look at what, from my side as an asset manager, what are we actually offering from our sustainable investing, and others like us, and who benefits from it? Because I think it is important when you try and tease apart what sustainable investing has achieved in kind of growing to the scale it has done. And the first and simplest thing is that we charge our clients, we charge them a fee to invest their money in a particular way. And the first thing is, we put them into portfolios where they avoid investing in certain companies. So we avoid investing in oil, tobacco, arms, gambling, etc. So they know they're not going to be in that. And then we positively invest in other sectors. I'll talk more about those later. And so there the client benefits from that. So there's a relationship between us and the client. And then in addition, we state as our aim to our clients, we aim to deliver them superior returns by investing in sustainable companies. Okay, and again, that sort of use of this lens of sustainability to generate excess returns is another thing that's between us and the client. No one else kind of benefits from that. Because then the wider sort of impact, I guess, or aim of sustainable investing, which is to try and change things at a bigger scale. So by engaging with businesses on executive pay, on board diversity, on modern slavery, all of these aspects as shareholders, we engage with those businesses, and that has an effect not just for the client who likes to hear about these things, but also hopefully has some improvement on wider society and the environment too. And then there's the sort of even bigger thing, which is sustainable investment's role in possibly steering that tanker of capitalism to a more sustainable path. And this is where particularly looking at the Sustainable Development Goals. Can sustainable investment help to push more capital to those businesses which are helping to provide solutions? And again, that's kind of much broader than the relationship between us and our client. And so I think those are the sort of main things behind what ideally we'd like sustainable investment to be delivering on. But I'll just talk now about why we think, and this is kind of concentrating on the second point, why we think there is a kind of proposition, behind this idea that you can invest in companies that are sustainable, that are providing solutions, and get a better sort of investment return. Because certainly in the days of ethical investing, the prevailing notion was that by sort of limiting yourself to a certain set of companies, you are foregoing returns. By not investing in tobacco companies, you are sort of missing out on the great returns that you can get as you get more and more people addicted to unhealthy cigarettes. That's the sort of the thinking behind it. So how can we possibly work against that by saying we can deliver superior returns? Just there's this yellow and black stripe thing here, Tim. Does it signify anything? Am I allowed to?
You are allowed to step over. We have so many cameras.
You get COVID when you.
No. It's just about optical camera angles. So.
Our office was COVID proofed by putting a yellow and black stripe around the photocopier. Only one person was allowed in that space at the time. But, anyway, we're not talking about meaningless stuff. So why do we think that's like? Well, first of all, we have this view that the world is improving. There are many positive trends in place where we can see fantastic progress, and we look at how we achieve that. And we think where we do that well, that can lead to some really successful business opportunities and investment opportunities. So some good news, because amongst the daily news, it's quite hard to find good news. But if you look longer term, so probably one of the most dramatic ones, child mortality. If you had a child at the turn of the 20th century, it had a 1 in 5 chance of making it to its 5th birthday. Now that's more like 1 in 300, 1 in 500. So that's in the UK, but also you can see China and the US. The dramatic falls that we've seen in child mortality. So absolutely phenomenal. It's sort of like 50 to 100 times improvement. Probably the most dangerous thing we do every day, drive our cars. Back in the 1960s here in the UK, it's up 8,000 people dying a day. That's now fallen. I think actually the lowest number now is more like 1,500. So it's a sort of 4- or 5-fold reduction in the number of people dying on our roads, and that's with a 10-fold increase in kilometres driven. So again, fantastic good news. And then air pollution. You can see this is when I started cycling in London. This is urban air pollution, PM10 particulates. And you can see how dramatically it's fallen to 2020. And it's not perfect, there's still a long, long way to go. But these are all examples of 40, 50 times improvements in things that were really bad for our life and enjoyment of life. And so we then sort of think, well, okay, how do we achieve these things? And let's look at how we achieve those and try and repeat it. And can we take that model and sort of apply it to other areas where we have these incredible challenges? Because I'm not sort of painting a kind of Panglossian wonderful picture that everything is fine. But there are certain areas where we have managed to make fantastic strides. So can we take that model and apply it to some big sustainability challenges so that we can see progress over the coming years? And the model we have in our head is that there are really three actors in this. And it's a sort of understanding of the science. So you understand that air pollution, you first of all measure the levels of air pollution. You then work out why it's so bad for your lungs and your health. Then government and society says, hang on, something's got to change, let's find a way to change this. And government does things to kind of move the bar. Actually, on the way in, I was listening to Sadiq Khan, the Mayor of London, talking about how he's dealing with air pollution in London. And he said the first thing I did was set up air quality monitoring stations all around the city, the densest network of air quality monitoring stations. And that gave him the sort of data and the knowledge with which to say, actually, we need to put an ultra low emission zone into London, and we're going to grow that to encompass the whole of London. And then businesses take the sort of technological solution, and they take this kind of reframed environment where maybe through regulations or taxation or just a kind of law saying you can't bring a car in here or a van in here unless it's electric. And then businesses do what they do best is they find the opportunity and they take the technology and develop it and distribute it widely. And they're a very, very efficient model for doing that. And the other aspect of businesses is that they can generate a profit. And some of that profit can be recycled and retained so that they can kind of continue this cycle and develop the technology even further. Government then goes, okay, the art of the possible has moved on a bit, so we can actually make it more constrained, and so the cycle continues. And that to us is our model of how you can affect really big change while bringing businesses into play. And that lies behind our investment strategy, which starts with our theme. So this idea that the world is moving to be cleaner, healthier, and safer. And I'll come to the themes in a second. But there was one other aspect of change that I wanted to talk about, which is that it's rarely linear. And this comes from a bit of work which was actually done by a group called Rethink X. And it's a set of photos which I think kind of shows this as well. And just out of interest, have any people seen these two photos before? No, okay, I think they should be rightly quite famous because this is New York City, and it's the Easter parade when everyone gets their shiniest vehicle out. And here is the only kind of thing that is motorized. Everything else is a horse-drawn carriage. This is 20th century. Everything else is horse-drawn carriage. Each horse does 20 kilos of droppings a day, apparently. I looked it up. It's true. So the massive local pollution problem. In summer the flies were abysmal, and in winter when it rained, you had to have people helping you across the street because it was sort of flowing in the snow. Then move forwards, just under 15 years later, in the same place, and the only thing that's a horse apparently. You've had this total flip, and that has happened because along has come. I know we don't think of it as in this way today, but at the time, here's a technology which is cleaner, cheaper, faster, and then if you think of the change that's required in terms of infrastructure, of all the oil, petrol complex that's needed, the mechanics, the servicing, you can just see how rapid these changes can be. They can be very, very sort of non-linear when you get this kind of cleaner, this cheaper and better solution. And I really recommend having a look at the kind of Rethink X material, because they also do an amazing thing on agriculture and this idea of that we've achieved peak cow, for instance. So this is kind of what underpins our thinking when we're coming to investment. This is why we think there's a link between companies that are providing novel solutions and investment success, investment returns as well. So, from that idea of ethical investing, which is saying, oh, you're foregoing returns over here, why would you do that? We sort of turn it around and say, well, actually, we're focusing on the bits of the economy which are going to be growing faster for longer, and that sits behind our themes, which are 20. We sort of isolated 20 areas of the economy where we see there being investment opportunities, strong growth, and where the businesses grow, as they grow, they're improving something to do with people and the planet. And so there's some which you probably find unsurprising in here, like increasing electricity generation from renewable sources. So that's long been a theme within our portfolios. We then also look at kind of quality of life and things like sort of healthier foods, innovation in healthcare, so the whole move to particularly themes around early diagnostics, stopping people getting sick or as sick in the first place. We see that as a sort of major positive trend within healthcare. And then within sort of this theme around safety and resilience, there's some things which are kind of slightly, I think, a bit boring, but we think are incredibly important. You only notice them when they're not there. But things like insurance, that ability to spread risk across the population, we think is absolutely critical to a sustainable economy. And so we sort of invest in insurance companies, for instance, when they do it well. And we also look at things like enhancing digital security. So as more of our lives move online, so we need that to be protected as well. So these are our 20 themes, and we look for businesses that have more than 50% of their revenues coming from a particular theme. So they tend to be quite well-established businesses already. What we don't do is invest in big companies that are trying to pivot to the next generation. So we don't invest, for instance, in companies like Royal Dutch Shell or BP or Exxon in the hope that they will make it through to be the leaders of the next generation, because historically it's incredibly rare that happens. If you think of that New York City photo, there aren't many horse and cart manufacturers who become car manufacturers. Kodak actually invented the digital camera. They couldn't kill their film business to become a success in the next generation. So we just don't see what the transferable skills are of a company like Shell or BP or Exxon to becoming a leader of the renewable energy generation. We might be proved wrong, but that's certainly not our belief at the moment. So just as an example, with all of these, there are winners and losers. Winners in terms of renewable energy generation, you can see it's probably kind of quite a well-worn thing, but just remember, the cost of these keeps falling. So you kind of get deflation. So region after region, the cost of renewable energy is kind of picking off the fossil fuel competitor as we go along. And so if you look at, for instance, in the US, coal has become very emblematic of a kind of political symbol of the coal industry. It doesn't matter whether you're Obama, whether you're Trump, whether you're Biden. This decline is just continuing. So there's been a 60% decline in coal generation in the US, and there's no signs that will stop. That's partly because there are fewer coal plants, partly lower utilization as more and more renewables come on stream, and also in part gas too. But that's the idea behind sustainable investing, or certainly the way that we do it. And so we're trying to find these themes, driving the change, expanding the markets, and we're trying to find within them firms, and this is quite important. It's not just any firm we're trying to have. We're trying to find the best firm that can maintain their competitive advantage. Because if you're going to be investing, you want to find companies that aren't going to have their margins competed away. They can kind of make those strong returns, and that's another reason why we like this in terms of investment returns, is that almost by their nature, the solutions are reasonably novel and new, so there are fewer competitors in there. It's not like a supermarket sector where it's been established for ages and everyone's kind of competing basically in the same ground. This is where you can have genuine innovation and companies leading it. So just an example of one company we own, just to give it an idea. It's a company called DocuSign. DocuSign do the sort of online contract work, and anyone who's used it will think, oh my God, that's so much easier than having to sign, witness, put in the post, send it on, get signed, witness, it goes round and round and round. And they sort of estimate, and this is the penetration of DocuSign into kind of contract management is still tiny as a market share. But even as they stand today, they estimate they save more than 20 billion sheets of paper, 2.5 million trees, and so we think this is a kind of real example of where you get a step change. You have an old technology which is cumbersome, and it's replaced by something different where everyone goes, oh God, well, thank God we've done that. That's made a big change. And so when we look at DocuSign, we sort of say, okay, it's 100% linked to this theme around circular materials economy. We look at how the business is run, how does it look after its workforce, how engaged are they, how happy are the clients. All of these things we think it does incredibly well, and we look at the characteristics of it as a business, and we think its valuation is looking, still looks very attractive as it grows in the future. It's clearly had a big pull through from COVID. The COVID lockdowns was a big impetus to get everyone to switch, but we think there's no reason why that shouldn't continue into the future. And so this is the sort of type of company that we have in the portfolios, but there are also, across our themes, you have, so DocuSign sits in one of these, where you have a range of themes. So it ranges from companies providing innovative healthcare. So we owned a company which was since acquired called GW Pharma, which had cannabinoid-based medicines to treat childhood epilepsy. We have smart metering companies which help on that sort of demand-side management of electricity. And all of these have in common that as they grow, they should be delivering a positive impact to sort of people on the planet. And we look at some aspects of that in aggregate at the portfolio level to give our clients a sort of sense of the positive nature of the businesses that they're included in. And so we sort of will measure things like the carbon emissions of the businesses within our portfolio. And if you invested in the benchmark, as in the MSCI World in this case, you would have 90% more, 88% more emissions than if you invested in our portfolio. So it shows that the businesses we're invested in, should there be an increase in kind of carbon price, are very, very underweight that risk. So that's the kind of the first aspect. 30% is linked to companies which are helping to kind of accelerate that transition, and 0% in fossil fuels. So it's kind of trying to pull together this kind of picture for our clients of the nature of businesses that they're involved in. And that goes a bit to this sort of storytelling side of things, which is something that's changed. Because you'll notice, I think, in the way that I talked about what we do, that I haven't spent a long time in saying how bad tobacco companies are, or how evil oil companies are, or how nasty and regressive gambling companies are. But I have to say that was, at the beginning, how sustainable funds were very often marketed. It was this idea of something virtuous, something you only did if you could make the effort, and you were likely to waste your time. So there's this bottleneck you have to go through. And in fact, I was trying to dig it out, but one of our first adverts, or the first adverts that went out for our funds when we were at a company called Morley, had a picture of a bottle bank and someone throwing bottle away in the bottle bank and saying, invest sustainably. And it's like, okay, I'm not sure that's kind of resonating, right? And then you sort of, and the story is kind of flip around to talking about, okay, well, let's talk about the companies that we are investing in, how exciting they are. And that's really the kind of approach actually that Tesla took to the idea of electric cars, was to make it aspirational, to make it so actually this is a better product. And that's certainly how we've always tried to position sustainable investment. You know, to be truthful and candid and clear to our clients about what they're getting, but to couch it in what we do every day, which is try and find these cool companies that are going to be successful because they're dealing with big sustainability problem. That's been part of it. It's been the storytelling. It has also helped that we and others have been now established for 20 years and have kind of shown that you can still make decent returns out of these strategies. But also, I think there's also been in that 20 years a generational shift in consciousness, and time and again we hear financial advisors and investment kind of consultants who say, okay, there's been the family or whatever are handing over the assets to the younger generation, and they want to change the way they invest. So there's a much more receptive audience out there, people who've sort of seen the blue planet and understand the impact and how connected business is with being sort of sustainable. So and the kind of story of us as a business ourselves, I think mirrors many of these trends I've been talking about in terms of what we look for in companies. Because we launched our funds at what was then called Morley, but it was a division of Aviva, in 2001, and the company made this bold decision to launch a set of sustainable investment strategies and sustainable future funds. And they stuck with it, and Tim has loyally been a member of our advisory committee. When did you join?
2009.
Around here. And we kind of ran these funds at Aviva, and they grew modestly. It wasn't a fantastic success, but we certainly sort of established a name for ourselves, and it was going well. The business came into kind of, I guess, difficult times and had to restructure. We sort of thought, they're not going to restructure us. We're growing. It might not be, shooting the lights out, but it basically came to pass that they said, actually, we're going to focus on our core business. We don't want to do sustainable investing anymore. So go find yourselves another home. And we ended up at Alliance Trust, and there was Alliance. I had to say at the time, I went and I sort of had to go and try and find people who were interested in buying us, and they were really the only game in town, the only company that particularly wanted to buy us. And so we stayed there for another 5 years, and we sort of doubled the assets that we ran. And then Alliance Trust came into its difficulties as well. And we, all through this time, I and my team, we've also felt this is a fantastic business. This is so logical that more and more people want to invest in this way. So if we can do this well, it should be a very successful business. But we had patience, and then Alliance Trust got into its own difficulties, and it sold us. And it sold us to Lion Trust. And Lion Trust is a bit like game pass the parcel. Pass it around. And Lion Trust sort of, I think, lucked out. They didn't have to do this 17 years of hard labour, and these are the assets under management. So just over 1 billion, 2 billion, and now it's 12 billion or so. In the last 5 years, and that's even in UK asset management areas, it's a phenomenal rate of growth over the last 5 years. So this idea of patience, a bit like the wind and solar kind of chart as well. It kind of goes along and then it kind of increases as well. So it sort of suddenly clicked, and so there's this sort of move from being ridiculed to now being a really important part of the investment landscape. So in a way, it's in the last 20 years, I look back and I say, this is an immense amount of pride that this has happened. That what we kind of dreamed about as a team back here has actually come to pass. But there are some I guess some concerns that we have, and I think anyone looking at this growth and sustainable investment should have too. And it's just the thing, that idea that half of all investments which are being managed are sustainable. Does it feel like we're in a world where that's the case? To me, not. And so I do worry that there's a bit of this that is being used in terms of greenwash or a fig leaf. This idea that we have to pretend that everything has changed so that everything can stay the same. And I think there should be sort of a hefty dose of skepticism in some of the claims, across the industry of dramatic change in the way that they manage their assets. I think as well, and this is something that obviously Tim writes a huge amount on, you can see that all of our themes are based around this idea of growth. We're looking for growth. It might be that this growth has lower impact, that the sort of resource intensity or energy intensity of what we're investing behind marginally decreases the amount, but it's still invested in growth. And I think that's a kind of bigger question. We're not pretending we've got an answer for that at the moment. There's also this idea, do you remember the UBS quote right at the beginning where it's the man holding his daughter and saying, we're going to make her life better? And it's this idea that sustainable investing can solve all the problems out there. That you have, there was a kind of wealth manager I saw who basically had a deck of cards of the Sustainable Development Goals, and will give those to clients and say, which of these goals would you like to solve? And say, okay. And I mean, just from my perspective, I just don't see how you can use investment, which is to do with money, to solve problems like poverty and hunger, even to a large extent biodiversity, where there's zero economic value to ascribe to them. I just think those have to be addressed by other actors or somehow brought into the economic system. But at the moment, I don't see how that works. And then there's also, I think, a big question about equality in capital markets, in that there seems to be a concentration of wealth going on. And the Tesla example is a kind of classic in that genre, and how wealthy it has made one individual. And does that fit with this idea of a kind of a just transition, or is there something at odds within it all? So those are some of my concerns with the kind of success that sustainable investment has had. But I don't want to end on that note, because I think it's been one of the incredible stories in the changing consciousness of an entire industry over the last 2 years. So do I think we've achieved? Well, I think you'll have heard the talk from Sean about the whole idea of empowerment through share ownership. The city and investment in London used to be somewhere sort of secretive almost, and only for the wealthy, and only this idea that everyone owns shares, I think is kind of very powerful. And if you think as an individual how you can affect change, you can vote, you can change where you spend stuff, you can go on demonstrations, but you can also choose where you invest, and you can choose what your asset manager does on your behalf. And I think that cat is very much out of the bag and isn't going back in. Are you allowed to use that expression? I don't know. Anyway, there's certainly been a lot of capital that's been provided to clean technology, to innovations in healthcare. This sort of, I think it wouldn't have happened to the same extent it has if sustainable investment hadn't been around. In terms of engaging with businesses, the things I would call out, right at the beginning of my career, there was a court case between GlaxoSmithKline, were taking the South African government to court for infringing on patents. Well, it wasn't just Glaxo, sorry, it was a range of big pharma companies for infringing on patents for HIV medicines that the South African government was importing from India generically. They made no money out of South Africa at all, zero sales. Morally, there was not a leg to stand on, and and they eventually pulled out of that. And there was a great campaign done by Oxfam, but they also cited specifically investor pressure to that. And now, interestingly, companies like Glaxo have a whole division which is based on providing cheaper generic drugs to developing countries as well. So I think that's something which has been pretty successful. Supply chains and human rights within supply chain, child labor, shining a light on malpractice. I think that again is one of the areas of engagement that has made apparel companies, clothing companies, be much more mindful of. And a lot of the challenge around greenhouse gas emissions and pushing and pressuring companies to disclose, put in place plans for a trajectory of net zero, has also, I think, gathered a huge amount of momentum, and it will affect quite a lot of change. And then there's more the sort of ideas around how businesses are run. This idea, certainly when I started out, was the sort of the primacy of a CEO's role was to deliver shareholder value, and that's it. And this was the Business Roundtable in the US in 2019, where they came out and they said companies should serve not only their shareholders, which is a big not only, but also deliver value to their customers, invest in employees, deal fairly with suppliers, and support the communities in which they operate. And just making that statement is, I think, a sort of indicator of how far we've come. But clearly, you're here looking at the problems we still have and have to deal with. So it's about the next decade. How do we take that model of those three elements, science and understanding, government and society and business, and provide the capital and provide the solutions to deal with mobility, energy, biodiversity, and heavy industry. This was the steel plant that I did my PhD study on as well. It no longer exists. But yeah, that's kind of for the next decade, an overview. And I'll stop there. Thank you.
Lisa, thank you very much. We have a little bit of time for some Q&A, and I'd also invite people online, if you'd like to ask a question, pop it in the chat, and I'll try and keep an eye on that. Let's take some questions. Gemma.
So obviously there is this whole idea that sustainable funds are there, but there are some sustainable funds that claim to be sustainable, but maybe are not. I mean, we were having conversations about where our pensions go the other day, and kind of a few of us here, weren't we? And we were saying that under the sustainable fund within our pension thing, actually, like you've got Exxon as number 6 on the list of top 10 companies. And I know that, for example, someone like my dad, he's not really in a sustainability world, but he's moved his pension to a sustainable fund and hasn't necessarily looked into it. So do you see regulation coming in to say, this is what you can class as sustainable funds, this is what you can't claim, or ESG funds or whatever? Do you see that coming in? Or
no, it is coming in. It is going. So in Europe, they've now regulated, it's called the SFDR, and they kind of come in to sort of say, this is what you have to do in order to get this certification. I'm a bit mixed on regulation because they have a particular view, and actually they were sort of trying to say, okay, well, nuclear and natural gas are now deemed to be green. They were making the decisions that we think between us and our clients, not to be made in Brussels. But I think there needs to be a degree of honesty and regulation, because the asset management sector has a long history of mis-selling. If they can find a way to sort of slightly sort of embellish what they're doing, they tends to have happened over time. But I think that there should be a degree of caveat emptor as well. So look through your portfolio and say, actually, does that smell right that Exxon's number 6 in the portfolio? And challenge them, because the more challenge that comes back, the better.
DocuSign's down 80% since last summer. What have you been doing during that time? buying or selling, or I don't know, what's your like strategy during a downtrend? What you do?
Yeah, putting on a sort of helmet and
Yeah.
no, clearly, and these things don't go in straight lines.
Yeah.
We've had, I mean that pharma company I mentioned, GW Pharma, that we held for 20 years, and in the end, it did fantastically well. There were times when it was down on its knees in terms of share price. What we do is with every kind of investment we make an investment case, we build the investment thesis, and we say, okay, on a 5-year view, what do we think this company can deliver in terms of profitability? And that's what we base our investment decision on. Clearly, as new news comes out, we look at that, we examine that, we test it against it. As things stand, we don't have a problem with DocuSign.
Just a question from online, which kind of links with that in a way. One of the things that's happened in the last 6 months or so is a lot has changed geopolitically. Yeah. And so it's Ben Gallant online just asking on thoughts on recent conditions. One of the things he asked about, which is very interesting, is that, I don't know if anyone's picked up on this, is the reframing of defence investments as ethical investments. Whether you have any comments on that, but also that the conditions, the financial and monetary conditions have changed, the impact that that's having on.
No, it has, and we're certainly not immune, and sustainable investment funds are going through a period of pretty poor relative performance. That's clear. But if you think of the long-term track record, that has had a global financial crisis, Brexit, the COVID pandemic. So we can't, predict what's going to happen, on a 1-year view, really. So we're trying to find these companies that are going to be longer term. And yet, there's been a lot of noise about, retrenching, and let's start digging up coal again. Let's start fracking. Let's start, and we just sort of think, well, what we're trying to find is cheap, secure energy. But forget climate change. Cheap, secure energy. What are you going to go for? The only thing that you can put in place quickly is renewables. Nuclear takes decades, and so we just think these trends are very firmly in place. In terms of the defence, our pushback on that was because there are all these arguments around defence of the realm, and we just say, well, find us an arms company that only sells to the goodies, and we're all ears. And they go, okay. So no, it's not part of our thesis. But what a really important thing, we're not standing here making a moral judgment saying oil companies are bad, arms companies are bad. That's not our role. We're just saying we don't think they've got a great sort of growth prospects in terms of their future.
Okay, lots of people. So I'm going to take 3 at a time. Chrissy, Joel, Smith.
Yeah, thank you very much. Really interesting. So I was just wondering a little bit about one of the limits of sustainable investment, so specifically how sustainable investment relates to unsustainable investment. Because I think as long as as you said, like there's a really good case for things like renewables getting cheaper, therefore you're looking at a paradigm shift happening from fossil fuels to renewables. But one, that takes a long time, and 2, I don't think that's the case in every case that ethical, sustainable investments are going to get you a higher return than unethical investments. So as long as you're relying on the motivations of individuals, how do you basically kind of shrink that unsustainable rather than just focusing on growth?
Okay.
Right. Good. Joel.
We sat here for the last 3.5 days talking about how all kinds of growth, or talking about how sustainability through the sort of definition of ecological economics means movement and growth. By definition, sustainable investment feeds off growth and further revenue. So there seems to be a fallacy in there where you are looking to build sustainability, but by definition, you are then still feeding growth. So how does one balance that and still consider
Smith.
Yeah, I mean, mine relates to that. I'd like to go back to the horse shit. Carbon emissions are today's horse shit, and that's obviously a key concern. But renewables aren't problematic. There's the huge issues to do with rare earth materials and the biodiversity impacts, which is a whole pandemic, because unsustainable land use change and so on. Like, how are you measuring the impacts not only in today's horse shit, but the other things that we don't see yet? So I think maybe addresses John's question as well. Right?
Tomorrow's bullshit.
Tomorrow's horse shit, yeah.
So there's some easy questions for you.
Future horseshit fund. I think it's very brand new. I mean, I think the first thing to say is we don't have all the answers, and we don't kind of hopefully don't pretend to. And so we're only looking for those investments where we can make the case that there's strong future returns, while as those companies grow, they deliver a positive outcome too. And just as an example, the solar industry in Europe in 2007, for instance, fantastic growth, delivering solar. They were terrible businesses. What happened? They all disappeared because the Chinese came along, threw loads of capital at them. They had no barriers to entry, and so it's not always the case that because you're a business involved in sustainability, you will do well. And then there are also always these studies done where people try and take unsustainable versus not sustainable and draw charts, and because academics love to study the stock market because there's lots and lots of data. And we just think they're kind of almost meaningless from the way you start doing that based on our approach to it. And then in terms of the growth, I mean, I think it is a big question, but what we're trying to do is to make things better from here. Is to say that, does this improve things from here? Does it improve resource efficiency? It's not giving the final answer as to where we get to. And then we try to look as many impacts as possible. And again, it's just like, is this, at the margin improving things? It's not delivering the perfect solution by any means.
There's another question online, also from Ben, actually, about that improving efficiency. Is it then a little bit liable to the problem of the Jevons paradox, that actually improvement of the efficiency increases the growth, which increases the output, which increases the damage?
I'm sure it is. I'm sure there is an element of it as well. There's also, isn't there a paradox in safety as well, and risk? The kind of car safety thing after seatbelts were introduced, accidents went up. But overall, we believe that you do end up with an improved well. But make no mistake, 80% of our energy system still comes from fossil fuels. Carbon emissions have been going up ever since, well, forever. But since the first IPCC conference, and shown no signs of diminishing. So it's a big challenge.
Right, a few more questions. Jeremy Sophos and Diane, did you have your hand up as well, Sean? Yeah, we'll do three at a time. I'll come back to you.
Yeah, so briefly, who's the constituency within companies to have this sort of shareholder engagement dialogue with? Because fundamentally, the changes that investors are arguing for must involve some sort of short-term trade-off if they haven't been sort of prescribed by legislation. So I'm curious where you engage and how that dialogue goes.
Okay.
Oh yeah, I want to do three. Sorry, Sophos next. Yeah.
So how would you recommend we can tell the difference between good and bad sustainable investment funds? You say half of all assets under management are sustainable, yet it's very evident they're not. And you've got things like Terry Fancy's major critique of ESG ratings, for example.
Sorry, so
You've got things like the former chief investment officer of BlackRock Sustainable Investment saying that he would move all his money out of sustainable investment funds because he thinks they're such rubbish. And because they're an excuse to charge higher fees. But for many companies, and for us, how can we tell the difference between a good and a bad sustainable investment fund?
Okay.
Diane.
So how do you approach your valuations? How do you take externalities? Are they priced in the security in investments? And also, I was just wondering, how did your fund perform? Give us
overall. And I should make the caveat that in no way is anything I say going to be an investment recommendation. But actually, interesting, this going to a bit about the one about engagement and the chap from BlackRock, who I think wrote what you termed the kiss and tell letter.
Yeah.
But so he said, and I think it's a really interesting point. He said, okay, Business Roundtable, which is all the biggest companies in the US, they've said, we're making this massive step. We're making a massive step to change the way our businesses operate. And he says, well, yeah, if they were going to do that, wouldn't they have to, if it was so important for the business, wouldn't they have to put it as a vote to shareholders? You know, where was that? So either they've not gone to their shareholders for something that's of enormous magnitude, or they don't actually believe it changes that much. So when we engage with companies, we found the most effective way is to link it to the success of their business. And the people we speak to have changed, because it always used to be, you know, we'd be in a meeting, we'd ask them a question about, you know, their employee satisfaction or about their supply chain, and they'd say, I don't really know about that. Can you go maybe make an appointment to meet with our sustainability team? They'll talk to you about that. Now it's much more front and center. So the CEOs tend to be you know, more kind of aligned with that. In terms of how you tell the difference between funds, I mean, I think look at some of the holdings in the funds, I think, and then just think, yeah, is this kind of the approach I would take? Is this, you know, does this feel right to me? I think that's probably the best way of doing it. And I think the other thing is look at the resources that the team managing, and if it's the same person who's been managing a non-sustainable fund who's now being given a sustainable fund to run, then you probably draw your own conclusions. But I thought it was a you know, it raised some really important points, that letter. The third, how do we value companies? The same way other people do. It's just we take our theme. So you know, we showed a bit about diagnostics in healthcare, and we say we think, yeah, health services are going to spend a lot more on early diagnostics than perhaps most of the market thinks, and we factor that into our view of the future for those businesses. And you know, we think the world will change faster than most people think, and so we factor that into our assessment.
Price on carbon for the future, although it's not yet there.
We don't put a specific price on carbon, not in all sectors. But I mean, in some we do, but we put a general thing that somehow the world is going to find a way to make carbon internalize the external cost of carbon. Does that kind of cover those three bases?
There's a related question online, just as we're looking at that. How much you consider their impacts on key themes versus the impacts of their supply chains on key themes?
Yeah, we think of companies in two dimensions. The first is what actually leaves the kind of factory gate, if you like. And so what is it they're being paid for? What do they produce? What service do they offer? And we assess that in terms of sustainability. So will the world want more healthcare? Will the world want more clean tech? Will there be more demand for cybersecurity? We think the answer to that is yes. And then we look at how companies are run. And so there we look at the operations both within the company and the supply chains where they matter as to how they're being operated and how impactful they are.
Sean.
I think you did say at the start talking about core part of your business model, obviously delivering greater returns than your competitors who aren't in as many sort of sustainable phases yourself. I think there was a slightly wrong looking at the remarkable growth in your assets in a sort of short period of time. And I know maybe you said there is a jump right, but maybe now is more of a follow period, let's say. But if it's as rosy in the garden, so to speak, not to be tried, but what is the not market failure, but what's preventing less sustainable funds from also getting in on the action, so to speak? It's just the difficulty of moving capital around all this. Do you know what I mean? If the returns are greater than, say, less sustainable competitors.
I see. Yeah.
In your
I mean, there's nothing really. There's nothing. I mean, I think it's sort of. you have to build the expertise. You have to. I mean, it's kind of this idea of efficient capital markets that it'll go to wherever, wherever the returns are greatest. I just think there are some built-in things within capital markets that preclude that, and one of them is the short-termism. We tend to hold companies for sort of, on average, 5 years, and some we've held for 20 years, and that sort of focus on short-termism. And there's also, I think, what I've experienced is it's very hard for people to imagine the future, to sort of say, standing in New York in 1900 and imagining that's all going to be full of cars. I mean, that's a big leap to make. And yet, when you're in 1913 looking back, you can say, oh, it's obvious. It's obvious that was going to happen. And so it is with our economy. I mean, the changes we've seen over the last 2 decades have been absolutely phenomenal. Businesses are worth a trillion market cap businesses that didn't exist 20 years ago. So I think that change and that dynamism is built into the sustainable investment approach, whereas many other approaches are sort of saying, we just want to kind of get a bit out of oil now and sell it then and move on that. So I think there are biases within the market stop it being perfectly efficient.
To some extent, that growth in your assets under management, particularly over the last few years, is an indication of that movement of money from unsustainable to sustainable.
Yeah, maybe. Yeah, it could be. I mean, but we're going through a period now where performance isn't as standout as it was, and so we shall see. It might be that we next time I come, that tries. But that's the way of business. There are ebbs and flows, and you sort of you have to manage them, and it's kind of realistic to expect that things don't go in a straight line.
John.
Kind of linked with that, just looking at Lion Trust, obviously.
Oh my God, this is terrible. This
just
didn't used to happen before.
No, but that's a subsector of obviously everything else Lion Trust do. What size percentage, or do you know the size of the sustainable investment funds compared to the other funds?
We're about a third of Lion
okay.
Trust.
And do you, on the back of that as well, do you see your funds being able to influence others at all, or not?
Yeah, the Lion Trust model is that each investment strategy sits quite distinct.
Okay.
But Lion Trust definitely wants to be seen as being a progressive asset manager, on sustainability issues overall, not just in our team.
Very good. Joel.
So if we're in a position now where reportedly all investments are in sustainable adjacent assets, but in reality clearly it's a lot fewer. How far away do you think we are from 100% of investment portfolios being sustainable? Is that even a possibility? Do you think that's even on the horizon? How, it's what, 20 years or potentially 20 years to get this far? How far away are we from that?
Well, I don't think there is a single sustainable company out there. Yeah, in terms of being 100% sustainable, I don't think you could. Everything's sort of, so it's degrees of being better, and I think it's actually there's a slide, this one, right? So I think this is when you talk about it. So yeah, our portfolio is much lower in carbon. So if you invest in our funds, you can sort of like think, great. We haven't taken a single ton of carbon out of the atmosphere. All that's happened is everyone else is owning the other stuff. So I think it's important to kind of realize what we are doing and what we aren't. This doesn't mean that by putting your ISA here, you can then fly to Australia guilt-free because you offset your carbon. It doesn't work like that. But we're just trying to, I guess, mobilize capital to help these businesses kind of do a bit better and grow over time. But no, I don't think there is an answer to your question.
I had one question from online. Smith, is yours very quick one? You can do it in a couple of minutes.
Well, just I'm kind of glad that you said that there's no sort of 100% sustainable business, and I guess I'm wondering, like, is there not a risk that by speaking about sustainable investment as a kind of a good thing, that we're kind of greenwashing the very idea of investment in a way as a whole, and kind of falsely giving the idea that actually the markets are doing good things, and just like Melanie's still in the room, and I don't want to give a question, but this thing of like financial extraction is always problematic. So are we kind of in a way covering up the bigger problem?
We just take that one question, one small question. No, it is. It's a big question. I mean, I guess for me personally, I think that given what's available for me to do with my time, this is one of the ways I can have the biggest effect on, I guess on the world and how business operates. And could we be in a system which is, is not up to the task and could never deliver? I think possibly. I don't know, my take on it is that we've got that 3-load diagram we have. In there is an incredibly efficient system for delivering solutions, but maybe it only applies to certain areas. Maybe this whole kind of free market capital economy has to just apply to a certain aspect of our lives, and not be all pervasive. So not try to apply it to healthcare, not trying to apply it to managing the North Sea fisheries and these common areas, and those things have to be dealt with in another way. But in terms of what we can do today, I think this has a powerful role to play.
So I think what you can see quite clearly, Peter, is that what I'm doing in my ecological economics module is training a whole cohort of people to take over my role on the advisory committee and be a pain in your side. And feel free to take all the names down. They're also quite good stock pickers, as we discovered. So you've definitely got some recruits there. I'm just going to finish on this one. It's just a little bit off the wall. But Chris Medland, thank you for your question. If you had planning consent for a foot and cycle bridge across the Thames that's proven business case and environmental case and represents high value for money, according to TfL, that has political support and a council willing to adopt it and some funding in place and piles in the ground, who would you approach for a contribution to get it over the line? I'm sure you're not allowed to give investment advice.
Who proposed that?
Chris, do you want to unmute yourself?
I thought it was Boris Johnson.
Yeah, no, it's not the Garden Bridge. Thankfully, it's a real pedestrian and cycle bridge, not a sort of vanity project. And it's between Fulham and Battersea, alongside the Cremorne Railway Bridge. It's projected to have at least 1.6 million uses every year. And it's something I've been working on for about 10 years now. It was originally called the Diamond Jubilee Footbridge, but it's sort of reverted to the Cremorne Footbridge, given that we're now approaching the Platinum Jubilee. But there is piles in the ground. It has started on site because of those piles in the ground. And we had previously raised about £22 million, but it's going to cost about 40. So we've been looking for naming rights sponsors, and we've talked to people like Volkswagen and Tata Steel, but with no joy yet. And the reason why it's so difficult to get funding for bridges, pedestrian infrastructure and cycle infrastructure in the UK is because there is actually a law against it, which means that people trying to offset their carbon can only do it through woodland schemes or schemes in developing nations. So we're looking basically for potentially either a corporate sponsor or some sort of trust investor for naming rights.
Coming across with a request for 18 million.
Yeah, probably more like 22, realistically.
Yeah, that's a good try, Chris. We'll let you know if we get any take up at this end.
I love the idea.
It's a nice idea. It's a good idea. Okay, thank you all very much for your questions. As I said at the beginning, it's always a great pleasure to have Peter here. And I'm sure you will join me in thanking him for what has been a stimulating presentation.